Rain hammers the glass tower, while a compensation committee signs a fresh buyback authorization beside untouched coffee and sealed board packets. Nothing illegal enters the room. That would be inefficient. The exploit arrives pre-approved, professionally catered, and perfectly disclosed. Downstairs, the Treasury team opens thick binders, confirms available credit lines, checks signatures, and calls the broker before the opening bell. The company is about to purchase its own shares, then applaud the resulting mathematics, as if operations improved overnight. The first order hits quietly, absorbing stock from sellers, while financial television debates whether management has suddenly discovered hidden confidence. Confidence is the costume. Supply reduction is the mechanism. Per-share optics are the product being manufactured behind the curtain. A clerk stamps the authorization, another updates the trading calendar, and millions of dollars begin circling back toward the company's own ticker. No factory expanded, no new customer appeared, yet the number of shares dividing the profit is now smaller. Printed earnings sheets slide across the conference table, each showing higher per-share results beside total profit that barely moved at all. The market sees stronger per-share performance. Executive dashboards turn green. Compensation targets move closer without demanding equivalent economic progress. Inside the finance department, printed forecasts show flat revenue, pressured margins, and a surprisingly healthy jump in projected earnings per share. This is the buyback glitch. Corporate strength simulated through arithmetic, then sold back to the market as operational momentum. A senior executive circles the new EPS figure, signs the presentation, and removes the pages showing total profit barely moving. The public receives the polished ratio. The board receives the full packet. Information asymmetry handles the rest with corporate manners. Outside, analysts gather beneath studio lights, while the company announces a multi-billion-dollar repurchase beside banners promising disciplined capital allocation and shareholder confidence. Sometimes it is. Other times, liquidity engineering is simply wearing the language of shareholder value to avoid uncomfortable questions. The broker keeps buying through the afternoon, reducing available shares while natural buyers mistake the engineered support for broad market conviction. Price strength attracts momentum funds, momentum attracts headlines, and headlines attract retail demand after the company has already moved first. A compensation officer unlocks a gray filing cabinet, removes executive award schedules, and places them beside the new repurchase authorization. Restricted stock, options, and performance awards all become more valuable when buybacks tighten supply and improve per-share metrics. A compensation consultant slides a thick report across the table, benchmarking management against peers using EPS growth and total shareholder return. The architects are not stealing the vault. They are adjusting the scoreboard, then collecting bonuses for winning the revised game. The company's operating floor tells a different story. Aging equipment, delayed maintenance, open positions frozen, and managers stretching budgets past reason. Cash that could reinforce the enterprise is redirected toward retiring shares because markets reward visible optics faster than invisible resilience. A forklift idles beside unreplaced machinery, while headquarters celebrates a higher EPS line across the freshly printed quarterly investor deck. The balance sheet absorbs the sacrifice quietly. Physical weakness remains off camera until the business cycle removes the flattering lighting. Back upstairs, the cash balance shrinks on printed reports while directors still demand price support and cleaner executive performance metrics. A bank syndicate arrives with loan documents, covenant schedules, and enough debt to fund another round of repurchases. Debt-financed buybacks leave a darker paper trail. Borrowed liquidity removes equity, while fixed obligations remain bolted firmly onto the company. Share count falls today, interest expense survives tomorrow. Asymmetric risk enters wearing a banker's tie. The wire transfer clears, the broker buys, and the company effectively replaces permanent equity with debt that demands punctual payment. Return on equity improves because less equity remains. The ratio smiles politely while balance sheet fragility deepens. Investors applaud the improved capital efficiency, while analysts skim past whether genuine productivity or financial engineering quietly reduce the denominator. The distinction matters when conditions tighten, because productive gains create resilience, while cosmetic gains create dependence on refinancing windows. At the annual meeting, executives describe disciplined capital returns, while security staff guide shareholders past banners celebrating record per-share results. The language is immaculate. The balance sheet is carrying more leverage. The company's margin for error is carrying less oxygen. A long-term employee watches the presentation from a break room beside a vending machine and a notice announcing postponed pension contributions. Systemic extraction rarely announces itself as extraction. It appears as optimization, alignment, and a temporary sacrifice required for competitiveness. The stock rises after earnings, executive options move deeper into profit, and the board congratulates management for delivering shareholder value. Meanwhile, the company's absolute earnings remain ordinary. Its debt load expands, and its operating resilience continues thinning behind audited footnotes. The next quarter brings softer demand, cancelled orders, overflowing warehouses, and pallets of unsold inventory stacked beneath harsh fluorescent lights. Now the buyback's hidden cost becomes physical. Cash is gone, debt remains, and the business needs flexibility it already spent. Management freezes hiring, cuts research budgets, delays maintenance, and negotiates longer supplier terms while looming payroll dates continue advancing rapidly. The shares once retired cannot return as emergency cash. Financial theater has converted liquidity into a historical stock chart. A rating agency team enters a windowless meeting room carrying debt models, downside scenarios, and questions nobody asked during the rally. The buyback looked brilliant under stable conditions. Under stress, it resembles a bridge built from quarterly incentives and borrowed concrete. Credit spreads widen as refinancing becomes expensive, and the Treasury team replaces repurchase schedules with urgent calls to nervous lenders. The payload is visible now. Upside was privatized through compensation, while downside migrates toward workers, creditors, and shareholders. A plant manager receives a sealed restructuring memo, while executive retention packages are approved several polished floors above the factory. The corporate machine protects specialized operators first. Apparently, the people who designed the fragility are essential to surviving it. Production lines slow, contractors vanish, and severance folders replace the glossy capital allocation slides once distributed throughout the quarterly investor presentation. The buyback did not cause every weakness. It simply removed the buffer that could have absorbed the impact. In another boardroom, directors carefully review a different case. Strong cash flow, modest leverage, funded obligations, and genuinely undervalued shares. Their buybacks can create real value because excess cash purchases genuinely discounted ownership instead of financing vulnerability. In that cleaner scene, the company has durable cash flow, modest leverage, funded obligations, and no neglected operating needs hidden backstage. The repurchase is then an acquisition of the company's own undervalued equity, not a cosmetic procedure financed by tomorrow's vulnerability. Trading screens glow red during a market collapse, while the same board that bought aggressively at record highs suddenly suspends repurchases. They behave like emotional retail traders in better tailoring, buying expensive stock during applause and hoarding cash when bargains appear. The boardroom television shows the stock at a record high, while directors approve the largest authorization in the company's history. Corporate timing often follows compensation cycles, market pressure, and executive confidence rather than disciplined valuation. Algorithmic compliance replaces judgment. Months later, the stock collapses, the authorization is suspended, and the company cites uncertainty while undervaluation spreads across the screen. The institution bought when optics were useful, not when ownership was cheapest. That is capital allocation reversed for executive convenience. Another filing lands on the legal desk showing senior executives sold personal shares while the company purchased stock in the market. Perfectly lawful in many structured circumstances, also perfectly useful for identifying whose liquidity the corporate balance sheet may be supporting. The public company becomes a buyer beneath the market, while insiders reduce exposure above it, each transaction wearing separate legal paperwork. No masked conspirators are required. Incentives coordinate behavior more reliably than secret meetings, and compliance departments sanitize the choreography. The final stage is narrative control. Management presents adjusted metrics, excludes restructuring charges, and emphasizes per-share growth during the conference call. Analysts ask about margins. Executives answer with capital returns. The question exits wearing a different suit. Behind them, investor relations staff circulate approved talking points, while the debt schedule remains buried near the back of the presentation. The market hears confidence. Footnotes record leverage. The stock chart settles the argument until cash flow corrects it. Two institutional analysts spread filings across a table, tracing total earnings, free cash flow, net debt, interest coverage, and repurchase prices. Per-share strength can be genuine. It can also become a polished alibi for a company consuming its financial armor. The final board packet lies open beneath cold morning light, showing rewarded owners, enriched executives, rising leverage, and weakened survival capacity. The exploit is not repurchasing itself. It is manufacturing strength through a smaller denominator while the enterprise deteriorates. The camera returns to the rain-streaked tower where cleaners remove empty coffee cups from the boardroom after the final vote. Subscribe for more forensic access to the legal machinery hiding beneath respectable corporate language and quarterly applause. On the empty conference table, the approved buyback file remains beside a debt schedule and the final executive compensation report. Like this data packet, then comment. When EPS rises, do you check profit growth or count the shares that disappeared?